What a week it's been for crude oil, down nearly 6%. That makes it down more than 25% from a four-year high it hit just 6 weeks ago. And gasoline prices down 37 days in a row. All of this affecting your household's bottom line. Now, earlier this year, Moody's chief economist Mark Zandi put a fine point on that, saying every penny increase in gasoline prices costs the American consumer $1 billion. So it works in the reverse, too. You're getting a discount here. You're certainly getting a little bit of what you would call the gasoline tax cut. A research note from a company called Capital Economics says the plunge in oil prices is putting $40 billion back into American consumers' pocketbooks. But for every winner, there's a loser. Is it crunch time for oil companies and those of you who invest in them? Who better to bring in than Barry Worthington? He represents no fewer than 150 American energy companies for the U.S. Energy Association. Good to see you, Barry. You know, part of the price drop, I was thinking about this, has to do with the very thing that's fast-tracking the U.S. to energy independence, and that's the shale revolution stateside. But OPEC has also slashed demand forecasts. What are you hearing from the companies you represent?
Well, what's happening right now is you have a combination of phenomena. The United States, Saudi Arabia, and Russia are hitting record output numbers for oil production. At the same time, there's complications with the Iranian sanctions on their oil exports. There were several countries that got waivers from those. That was a bit unexpected. So that we have increased production and continued Iranian crude in the global marketplace. And then, Liz, you combine that with the notion that right now we're in a slow driving time of the year. From mid-September to mid-November is slow. The weather's not bad yet, so it's not that cold. So people haven't been using home heating oil. So the market fundamentals are a combination of these factors. Well,
I did a quick search of various oil companies because our investor audience loves to know where to go next. And they're at a discount. You know, you have Apache, Exxon, Marathon, Transocean. I was looking at all of those. All are down year to date. Actually, Marathon might be up just about under 2%. But then I thought, let me look at the XOP, which is that oil and gas exploration exchange traded fund. It's just at a bear market for the quarter. I mean, it looks really bad. These stocks are getting hammered. Something's got to give, Barry. Will we soon see them put in the position where they self-regulate and cut their own output?
I don't think you're going to see that in the United States.
Why not?
Well, because unlike other countries, the oil industry in the United States is all privately owned. They have to make decisions based on what's best for their individual corporation. They actually cannot get together and say, I'll cut 5% if you cut 5%.
Right. We're not an OPEC cartel. I get it. But I'm saying independently, I bring this up because Canada, the Canadian price of a barrel of oil just hit U.S. $50. So it's trading even at a discount. That's a record low for Canada. And there's a company that I saw. It was really surprising to me because when you see these companies say, you know what, we need to not be putting out so much, Cenovus Energy, it's calling upon the government in Alberta, you know, they've got the oil sands up there, to temporarily ask for people to cut output for all the drillers.
Well, the prices coming out of Alberta have more to do with a lack of pipeline capacity because they didn't and won't build, well, have not yet decided to move forward with the Keystone XL pipeline. You're shipping oil out of Alberta by rail instead of by pipeline.
Right.
It's
so there's
more
a bottleneck.
Expensive. Yeah, it's a pipeline bottleneck. We see it in parts of the United States as well. But that's why the price differential between U.S. crude and Canadian crude, they have to sell it at a discount because they can't get it to market.